What are investments and how do they work? This video is going to answer both of those questions and a whole lot more. Make sure to watch this all the way through to the end if you want to learn what investing is, what you can do to get started, and the easiest way to make yourself rich through investing. Hi, I'm Evan and I am an investor. I'm pretty casual about it. Every week I put aside some money that I hope was going to grow into more money over time. In a sense, this is the basic definition of investing. We want things to grow in price or value over time. There are different types of investing. You can invest in assets, which you hope will become more valuable in the long run, and this is what most people think about when they hear investing. Or you can invest time and money into improving yourself or your life. This can be about personal growth or it can be about making more money. If you invest time into mindfulness, you can become more focused and less stressed. Or you can invest in getting an education or learning a skill. These can both increase the amount of money that you're potentially able to make. Increased earnings will help us with the first kind of investing. You may have heard investing described as the process of buying low and selling high. So what are we buying and selling? That would be assets. Very generally, assets are anything that we can describe as having value. The easiest asset to think about is cash. We can buy and sell things with cash, so it definitely has value. Things like stocks, bonds, and real estate are all types of valuable financial assets. But what do they have in common that make them investments? The answer is our expectations. Investments are things that we want to either grow in value or to make us more money. Increasing in price is called capital appreciation or capital gains. Making money comes from receiving occasional cash payments from certain types of investments. Essentially, buy low, sell high describes half of investing. You bought something that grew in price and then you sold it. You profit the difference of the sold price from the purchase price. But this ignores the other half of investing, making us additional income. This is the goal of both traditional investments like bonds and personal investments like education. We want to be able to make more money. There are some investments that are able to both grow in value over time and make us additional income. The best example would be stocks. Stocks are a type of investment. We call the different types of investments asset classes. Stocks are a part of the equity asset class. Equity just means ownership. This is because stocks give you ownership of a company. If you own one stock or share in Ford, you own a small fraction of that company. Companies issue or sell stocks to raise money for running their business. Companies will trade control of their business to shareholders like you to make more money now. This money will then be used to improve the business. As a reward for investing in the company, you get to experience its gains, but also its losses. If the company is successful in improving itself, then its share price should go up. The value of your stock going up over time is the capital appreciation part of investing. Companies can further reward shareholders with dividends. These are periodic cash payments. When companies succeed and make a profit, some of the money they're making is held as cash on hand. They then give this cash out to shareholders as a thanks for being invested in the company. These dividends are typically paid out every 3 months. Dividends cover the second income generating half of what investing is. Companies pay out these dividends as an incentive to keep people invested in the firm. This is because stocks can be risky. If the business fails and goes bankrupt, then its shares are going to go to zero. This makes your investment in them valueless. Stocks of individual companies are one of the riskiest things that you can invest in as a beginner. The trade-off is that stocks normally grow faster than other types of investments. We call how quickly this growth happens the rate of return. Historically, the stock market grows by about 8 to 10% a year according to the S&P 500. This is an index which tracks the general performance of the US stock market based on the returns of the 500 largest companies in the country. The average is taken over the long run. In any year, the returns can be way higher than 8 to 10%, or it can also be way under. We've seen both happen in just the past few years. The riskier something is, the higher the rate of return it should theoretically earn you. This is illustrated by the risk-reward or the risk-return relationship. It says that investors expect to see more return for assuming or taking on more risk. This is another classic saying, no risk it, no biscuit. Let's say that you don't want to start investing in stocks because you have a low risk tolerance. So what are some of your other options? A very popular one would be bonds. Bonds are basically IOUs issued by governments and corporations. These organizations use bonds in the same way that companies use stocks, to raise money. They also use this money to improve themselves so that they can repay that money later. You give money to the bond issuer and they promise to repay that money after a certain amount of time. That's called the maturity of the bond. Along the way, most bonds will give you periodic cash payments called coupons. These work very similarly to stocks dividends, but coupons are normally paid every 6 months. You'll know exactly how much you'll earn in coupon payments when you buy a bond. This is because the coupon rate is set in stone, at least for most types of bonds. When the bond is issued, most bonds are offered at $1,000 face value. This is the amount of money that's paid back in maturity. The coupon rate is the percentage of the face value that you will receive in coupon payments every year. So a 10% coupon rate means that you're getting $100 a year, or most likely $50 every 6 months. In the year of the bond's maturity, you get both the coupons and the face value back. Bonds will sell at above or below their face value depending on interest rates and other market conditions, but that's beyond the scope of what's important. The predictability of bonds is what makes them not as risky. With less risk though means less return. Bonds will net you an average 5% annual return. This assumes that you reinvest your coupon payments rather than pocketing the cash. Not all bonds are created equal in terms of their risk though. 3 agencies give bond issuers credit ratings based on how likely they are to repay their debts. A company's credit rating is very similar to your credit score. The highest credit rating means that there's next to zero risk of you not getting your money back. This is called default risk. The primary example is US government bonds, which are also called treasuries. At the bottom of the credit rating scale are junk bonds. Because these companies are unlikely to repay their debts, they have to offer higher interest rates to entice investors into investing in their bonds. The problem that most people have with bonds is that they're boring. And if you're young like me, you should be able to invest in riskier things that will be able to make you more return in the long run. In that case, you could look at the commodities asset class. Commodities are just non-financial assets which have value. Examples include gold, art, and oil. Commodities are super risky because it's really hard to predict what they're going to do in both the short term and in the long term. Look at the price of lithium, which is used in electric vehicle batteries. Prices have gone through the roof due to increased demand and production shortages. So that's craziness in the short term. But then imagine that we find a material that's better for making batteries than lithium, which would make lithium worthless. That's unpredictable in the long run too. Plus, what are you gonna do? Go to the store and buy lithium and then put it on your shelf and hope it just increases in price? I don't think so. Instead, most people invest in commodities through index funds. These try to track or match the performance of some sort of other asset, most popularly the S&P 500 like we talked about earlier. Index funds will normally be exchange traded funds or mutual funds. These types of investments invest in other investments by following some sort of a strategy. One would be to buy and hold gold. Another could be buying bonds with high coupon payments. And another could be buying stocks with high growth potential. The possibilities are nearly limitless, as are the number of ETFs and mutual funds out there. Mutual funds and ETFs work by pooling their money together from a bunch of different investors so that they have the cash on hand in order to be able to buy a lot of investments. The investments held by mutual funds and ETFs are their assets under management. By buying into a mutual fund or ETF, you will have partial ownership of its assets under management. This gives you super easy access to diversification. This is what you do to keep yourself from putting all of your eggs in one basket. If you instead didn't diversify and invest in just a single company, well, that's not great if you drop the basket or your company goes bankrupt. The general difference is that mutual funds tend to be actively managed, whereas ETFs are pretty passive. ETFs are normally cheaper because of this passiveness. In general, active fund managers or the pros are actually kind of bad at beating the market, or even just passive funds. The variety and amount of different mutual funds and ETFs out there is great because you should be able to find something that will be able to meet your risk tolerance and goals, whether that be price increases over time or steady income. Another interesting investment option that can do both for you is real estate. The real estate asset class is basically physical properties and REITs. I've covered these recently. The difference is investing in actual buildings that you'll have to own, operate, and maintain. Or you can pay another company, the REIT, to do that for you. Managing physical property means you'll have to scout out locations, go through the process of buying them, and then continuously collect rent from your tenants. In contrast, REITs pass 90% of their taxable income to their shareholders, which would be you. While you'll get a smaller portion of the revenue generated by the property, you'll also have to do much less work if you invest in REITs. Many REITs are traded on public markets just like the mutual funds and ETFs we just covered. This means that you can very easily invest into them. Now that we know a lot about the different types of investments and how they work, well, how do we get started with investing in them? If possible, you'll want to start by making your investments in tax-advantaged accounts. I talk about these super often, but it's because they're super important. They let you save money by letting you pay less or no taxes on your investments. This means you get more money in your pocket for doing basically no extra work. You can invest up to $30,150 between your IRA, 401k, and HSA if you qualify to have those. So what should you invest in? Given the risk-return trade-off, stocks will normally be your best bet. But of course, you should diversify or not go all in on any one thing. I would recommend not picking individual stocks to start. And I would begin by investing in broad market index funds, such as those which track the S&P 500. Classic, not a financial advisor disclaimer though. I use Fidelity, so I own a lot of their S&P 500 index fund, FXAIX. Of course, I also diversify by buying assets like REITs. By investing heavily in broad market index funds while I'm young, I'll most likely see rates of return higher than what 50% of the pros are getting. You can utilize this exact same strategy with whatever broad market index fund makes the most sense for you. The sooner you start and the more money that you're able to invest, the more money that you should have in the long run thanks to the time value of money. The long run is also extremely important. You're going to have to deal with the occasional downswings in the market. While it obviously sucks to see your portfolio going down, mine's right there with you can't panic and just start selling. The best move is to just hold long term since the market has always recovered given enough time. With that, make sure to hold your mouse and click that like button. It'll help this video in the long term in the YouTube algorithm. Please subscribe and ring that bell if you'd like to be notified when new videos come out every Friday. It's free, it really helps me out a ton, and it helps others find this incredible advice which can change their lives and improve their futures. Click the video on screen to to watch another that you're going to enjoy, and then please add some music, some investments, or whatever else it is that you love to your day.